Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group, and today's topic I want to go over a thorough review on MassMutual annuities and go over some of the pros and some of the cons, why someone might want to utilize a MassMutual annuity, and then why many times a MassMutual annuity is not going to be the best option for that individual's situation, for their specific goals. Now, based upon the current times, now understand these things change. So, like any sort of companies that have annuity product lines, what might be offered today could be completely different from next month or next year or et cetera. Any time frame. So it all depends upon a couple different factors. But just with today's types of annuities, and I'm filming this video in 2016, what are their major sources of annuities, or what are their major annuity product lines? Kind of expose what's good about them, what's bad about them, and then how to avoid any sorts of negatives if either you're thinking about being placed into that type of a contract or currently in that contract, how to maximize out those results best way possible. So when we get started, the three major types of annuities that MassMutual offers is a fixed annuity, you have an income annuity, and then they also have variable annuity options. So with the MassMutual fixed annuity, you have to think of it very similar to kind of like how a bank CD works now, or interest rates like treasury bonds. Annuities are typically very safe products, and they have to be offered by insurance companies. So MassMutual is obviously an insurance company. Just like a bank, insurance companies cannot offer bank CDs, just like a bank cannot offer annuity type products. Each criteria has a different set of legal reserve structure that are particular to that entity that's offering that contract. So when we're going through a type of bank CD versus a fixed annuity, typically you had, and this used to be a major way on how individuals were able to retire back in the day, back in the 80s and 90s, is an individual could go take a portion of their savings, throw it into a CD or throw it into fixed annuities, and live off of that interest year by year and never dip into their actual account, never dip into their principal. So as long as they're living off the interest year by year, they're able to utilize that interest as income, and then after X amount of years that they got set up, if they got set up in a 5-year bank CD, they would then take the dollars after all that interest was paid out and then reinvest it into a new bank CD or a fixed annuity. They would go take a 5-year fixed annuity after all that interest was paid out and those 5 years have been sufficed, and they'll purchase a new 5-year fixed annuity. So this is when interest rates were so much higher than they are today back in the 80s and 90s. This would be a very successful way on how individuals were able to properly retire. Well, now MassMutual, they still have a fixed annuity, and the major difference between the bank CD and the fixed annuity is obviously CDs can only be offered through banks, and the fixed annuities can only be offered through insurance companies. When a bank CD, with that same example of a 5-year bank CD, let's use $100,000 for easy math. Right now, bank CDs are maybe paying 1%, as opposed to fixed annuities might be paying 2%. So back in the 80s and 90s, when you had bank CDs that were paying 10%, fixed annuities were paying 12% or 13%. So that would determine whether a person would place their dollars with a fixed annuity over a bank CD, was because they had a more attractive guaranteed rate of return. With the bank CD right now, if you had a 5-year bank CD, we understand, and this person put $100,000 into this plan, they would be getting paid 1%, which is $1,000 first year, $1,000 second year, $1,000 third year, etc. So they would have been paid $5,000 total. With any sort of fixed annuity, that growth, that individual could typically take it out where each time that they're receiving a gain. So if they have 2% in that same $100,000 example for a 5-year annuity, we know that $2,000 is getting paid out each and every year. Now, rather than having to pull out that money each and every time, they could allow that $2,000 to then compound, and now the account value is sitting at $102,000 after the first year. Then it's going to be 2% off of the additional $102,000. So you have the power of compound interest as opposed to the power of simple interest. But the main premise why somebody would want to get into a fixed annuity over a bank CD would be mainly because that interest rate is going to be higher. It's typically going to be higher. So that's one of the product lines that MassMutual offers. Their second product line that they offer is the income annuities. And what this is you might have heard it as a QLAC or DIA, a deferred income annuity. And what it's saying is, and this is a major reason why annuities have a lot of bad reputation, was because a person would go take dollars, let's say the same individual, this person's 60 years old, and he was to go and place $100,000 with a MassMutual income annuity that he was going to trigger in exactly 5 years for lifetime income. So what the company does is offers this person a specific computation that says if you give us $100,000, we'll provide this male, age 60, that's going to retire in 5 years, that's looking for a 5-year deferral, we'll give him $5,000 every single year to the day that he dies. So the good thing is, well, he's receiving lifetime income now from that $100,000 investment. He's receiving a 5% cash flow, 5% lifetime income for that individual. The downside to this, if he chose the lifetime income option, is if he passes away, well, now the insurance company makes out like a bandit. MassMutual would make out like a bandit. This is just a generic example. This isn't real numbers. This is just a generic example of how these income annuities work. Let's say this person had one payment of $5,000 and then died. Well, now MassMutual walks away with $95,000 of pure profit. They only paid out one income stream of $5,000, and then that person does not leave any sort of money to his beneficiaries. So that's where you really have to see the smoke and mirrors of income annuities. I absolutely hate them because I believe that the individual, that the client, should be receiving as much control as possible and leverage the contracts, leverage the insurance companies to primarily what their benefit is. If someone's utilizing $100,000 and they're placing it in, they have an income goal of exactly 5 years they want to retire, well, let's make sure that this cash flow percentage is maximized with whatever the top carrier is. And it also, if God forbid this person was to pass away, whatever's remaining would now go to the beneficiaries. The third option that MassMutual also utilizes is something known as a variable annuity option. And this is something that I disagree with. I talk really badly about variable annuities. Sometimes you do have some good variable annuities out there. I've been toe-to-toe with variable annuities that were set up a couple years ago, and I told the clients, I said, listen, there's no reason to switch out of it. It's better than anything else that's offered currently. But none of those annuities were ever with MassMutual. Now, this is just my personal opinion, but variable annuities have very high fees, and they're still susceptible to downward market losses because you have insurance-related fees on top of investment-related fees and a whole combination of fees with downward market loss that could occur against your accounts. So therefore, you have an uphill battle struggle your entire time that you leave dollars with a variable annuity or with variable annuities regarding with MassMutual. Now, right now, MassMutual doesn't have an attractive variable annuity option. You have hundreds of different carriers that have more attractive variable annuity options out there. If you're looking mainly as a safety play, there's no reason to go into a variable annuity. And reason being is because you're susceptible to something known as reverse dollar cost averaging. What it says is if you leave your dollars, if you have that same $100,000 example and you place it in with a variable annuity, this variable annuity is going to have mutual fund related fees. It's going to have insurance related fees. And on top of it, the advisor that's recommending that variable annuity to you could charge you an additional fee known as an advisor fee. You could add riders onto these types of accounts, which are additional benefits such as death benefit riders, or some variable annuities out there have income riders. That's an additional fee for that additional benefit. Now, everything in combination with these fees, typically variable annuities, they range from in between 3 to 8% in fees in a given year. So that's something that your account, that your mutual funds that's tied to that account have to beat out just to break even. If you have something that you're paying 4% in fees and your mutual fund performance, let's say, loses, or let's say just gains 3% that year, well, you're still out minus 1% because you didn't beat out that fee. The other negative is downward market loss potential. And 2008 is a very key year. Why? Because individuals were spoiled thinking that the market should always go up, and the average investor, the average portfolio lost 57% worth of value. Let's say in this account, this individual just lost 50% of value or 10% of value. Well, you use 10% and you add on that additional 4% in fees, and now you have minus 14% that 1 year from your account, whether that's a retirement account or non-qualified accounts, whatever the case may be. So MassMutual does have annuity options, but what I've seen is compared to all the different products out there, MassMutual is never going to be the top option. MassMutual is very good. They have their own lane regarding life insurance. Not so much on their annuity platform would I recommend a MassMutual annuity. And let me go into section number 2 and explain this in more detail. Here at Afasi Financial Group, we're an independent agency. So what it allows us to do is offer every single carrier out there, and then each proprietary strategy in conjunction with these carriers and their different contracts, so we could give you an overall solution, making sure that for each dollar you're placing in with a specific financial product, it's being leveraged the best possible way. Maybe company ABC is better than MassMutual, or company XYZ is better than MassMutual, or maybe MassMutual might come back in first place. But at the bottom line, if you have hundreds of different carriers and multiple strategies, you want to make sure for each dollar you're placing in there, why would you place it into an inferior product than something that could blow the doors off of what that guarantee is, what that safety is? And that's what brings me to the second point, is interest rate risk. With the fixed annuities are good because it gives you a levelized fixed interest rate year by year. But if MassMutual, and we'll just use an example, if MassMutual is giving somebody a 2% interest rate on, let's say, a 7-year fixed annuity, but yet you have another company with the same rating that gives a 4% interest rate that's just as safe as MassMutual, why would you go into a MassMutual product? You want to make sure if you're placing $100,000 or any dollar into a type of product, go with the one that has double the percentage, double the guarantee than the MassMutual product. When we're looking at income annuities, the downside to that income annuity aspect is loss of control. You have certain options that you could choose. You could choose a life-only option, which allows an individual that if they defer an annuity, if they take $100,000 like that previous example, and they want to defer 5 years or 30 days or 2 years, whatever the case may be, we'll just use a 5-year example, maybe the MassMutual might give them a $5,000 per year annual income per every $100,000 that they place into that contract. But if this person chose a life-only option and he was to pass away, well then all of that additional money that was not paid to out, so let's say this person lives for 2 years. Well, we understand $10,000 would have got paid out to this person. $90,000 now goes back into the insurance company's pocket. So they understand this risk. They understand how much control they could leverage when they're utilizing the law of large numbers and always make a profit. So my recommendation, which counteracts this loss of control, is place your dollars, if you're looking for a lifetime income play and something that's going to maximize out your cash flow, how much income you're going to be receiving with a 5-year deferral, rather than go into something that's going to pay you $5,000, why don't you go into something that might pay you $7,000 or $6,000? And when you pass away, unfortunately that individual passes away, have the account value, whatever was not taken, go directly to the beneficiaries. And on top of it, that account value could still grow whenever the markets go up and not lose anything whenever the markets go down. They're known as hybrid annuities. And you have multiple carriers, hundreds of different carriers that offer that type of product. So therefore that one could beat out the MassMutual income annuity or deferred income annuity. The third option that I mentioned was variable annuities. And that's because you have a combination of fees and downward market losses that could completely hinder your account. Some individuals leave their dollars with a variable annuity. They try to pull out income from this account. So now you're dealing with fees, downward markets, and income that you're trying to pull from this account. And that's why it's a combination of negative aspects. It's a vortex of negative aspects that's working against your account. The power of compound interest working in a downward direction. And that's where you just want to make sure for each dollar that you're leveraging, how exactly could you make sure that your solution is met, that your retirement solution is met. Here at Afasi Financial Group, we work on a national basis, so it allows us to deal with many clients every day, every week, and we see multiple situations. What we've noticed is the happiest clients are not the ones that try to risk their money and have a good gain one year and then a bad loss the next year and have that risk there. It's mainly the person that has these three main factors set up properly. The first one is an income source. When someone's looking to retire, and let's say they're in their 60s, they want to make sure that whatever their expenses are, whether that's fixed expenses or inflationary expenses, are covered. The ways that income sources, that income could come to an individual for retirement is typically Social Security. If a person is offered a pension plan, now unfortunately majority of individuals are not offered pension plans. And then the third aspect is savings. So if somebody's Social Security income and pension income, let's say equate to $50,000, but yet this individual has $60,000 worth of expenses each and every year, and then those expenses could even increase each and every year through inflation, well, this plan is not set up properly, so therefore this person has to pull from savings. The mistake is made that individuals go and they place their savings dollars into variable accounts where they have that reverse dollar cost averaging effect. What we try to do is say, based upon your savings, what's the smallest amount of dollars possible that you could place into income sources such as an annuity, but make sure that you're leveraging the best annuity out there, the best quality company that gives you the best possible guarantee for someone who's 55 looking to retire at age 65 or 60 looking to retire at age 62, whatever the case may be. It has to be niche offering particular to your situation. Everything that you don't use up, so if you're placing the smallest dollars in there, in this example, you have a $10,000 gap. If we could suffice that $10,000 gap, well, now you have that income sources protected. Everything additional could now go into emergency funds or could be placed into those variable accounts where you could risk that money. You're not susceptible to, if the market goes down, you don't lose your confidence in retirement because you know that your income plan was already set up. And then that third option is the inflationary protection that says some of your expenses are going to be fixed, some of your expenses are going to have are going to be caught up with inflation, meaning that those expenses are going to be increasing each and every year. So it's how exactly do you set up a proper plan, making sure that you're increasing in income each and every year. If you want to trigger income at age 65, well, how do you make sure that there's a step up at age 68, at age 71, at age 74, etc., for the rest of your life, so that when you're placing your dollars into any sort of financial vehicle, for retirement account, whatever that case may be, you're making sure that income is maximized. So we're covering the income sources, emergency monies, and inflationary protection at all points of time. If you found value in this video and you want to see whether or not the MassMutual annuity is going to be the best for you, or if there's going to be a whole different slew of options better out there, then I recommend to give our 1-800 number a call. It's 1-800-566-1002. We offer 24/7 customer service, and we utilize a process known as the Retire Sharp planning system that allows us to go on average, which each individual that calls up, we figure out exactly what their situation is, what their goals are, and how exactly to make sure that these three main sources are covered. From there, we go through over 1,200 different contract scenario strategies before we give our top 3 recommendations, giving you that peace of mind that, okay, if MassMutual comes back in first place, go with MassMutual. If it comes back in 10th place, well, then there's no reason to go with MassMutual. So it's all about you controlling the chips, you understanding which contracts are going to give you the best offers based upon your specific situation. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints, and it's because of this methodical process. I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys. Hope you enjoyed.